Hey everybody, welcome to the first weekend market update. I'm Kevin. This is the first time we're doing this because normally we do this as part of the ticker talk that we do every other Thursday when we're looking at your tickers, and we usually start out by kind of looking at the whole market. But we thought we'd pull that out of there and make it a separate thing that we do on the weekends so that we can look at what's coming up for next week, see if we see any opportunities for the week. Talk a little bit about what happened last week, but we're mostly concerned with what's coming up. So we'll give this a try and see how you like it. Let me know. And of course, if anybody has any questions after watching the recording, feel free to ask me in the Ask a Mentors channel or the stock market chat channel would be a good one. You know, and if you want to get some discussion going about some of the stuff we've looked at, that would be great. So let's get right into it here. Well, first, quick little disclaimer. You've all seen this before, I'm sure. Everything we do here is for educational purposes only. We are not investment advisors and do not give investment advice. All statements are my own opinions and are not to be considered advice to buy or sell any security. All trading decisions are your own and done at your own risk. Okay, now we got that out of the way. So here's what we got coming up this week. It should be a fairly interesting week. There are some really important economic data points coming out during the week, so we'll be watching those closely. For tomorrow, Monday, not much going on. It's pretty quiet. There will be some Fed heads talking here and there through the week, but I think we've heard what they all have to say. They've made it pretty clear they're all hawkish, even the ones who used to be dovish. So I don't expect a lot of market reaction when these guys speak. Maybe if there is any, it's probably very brief, unless somebody comes out and surprises us with something. Tuesday, though, we got the big one, CPI, Consumer Price Index, also known as the inflation report. This is expected to come in, with even more inflation. It's expected to show that inflation keeps rising. So that's the expectation. If it does come in a little hot, then, the market probably doesn't respond to it too much. It probably doesn't care. If it comes in light, the market, could very well rally. If it comes in really hot, a lot higher than anybody expects, then we will definitely see a pullback in the market. So yeah, that'll be interesting. And if you're reading the morning briefing, you'll get a warning of this, of course. Although this print does come out before the market opens on Tuesday. Also on Tuesday, we have the 10-year bond auction, and you're probably aware there's just some craziness going on in the bond market. We'll take a really quick look at that in a few minutes. So this can cause a little bit of fireworks right when the report comes out. It usually comes out about 1 o'clock on Tuesday. On Wednesday, we have the PPI, the Producer Price Index. It's another inflation metric. It's showing us how prices from producers, the people who make the goods and sell them to us, what their prices are looking like. And again, it's another inflation print, but with the CPI the day before, there shouldn't be a whole lot of fireworks. What could be big fireworks is the earnings. Earnings season is firing back up again. Officially starts with the big banks, and it is on Wednesday morning, I believe it is JP Morgan. Will be announcing their earnings. And we also have, and again, I'll put all of this into the morning briefings, but we've got JP Morgan, Goldman Sachs, Wells Fargo, I think Morgan Stanley, all reporting next week, either Wednesday or Thursday. On Thursday, we have retail sales. That's an important number. It's important to tell us how the economy is doing. I think we're expecting a little bit of slowing there. And one of these things, it's maybe sounds a little contradictory, but I think a little bit of slowing in the retail sales, as long as it's not too much, it's a little bit, could actually be good for the market. Because it's showing the economy is starting to cool a little bit. If retail sales are slowing, and that's what the Fed wants to see, right? The Fed wants to see the market or not the market, the economy cooling off, and therefore inflation cooling off. So that'll be interesting to watch for on Thursday. And then on Friday, we all get a holiday. Markets are closed for Easter. So I hope everybody has a happy Easter weekend. Hope you're, got some plans, maybe get away or something for the weekend, and totally forget about the markets. Hopefully I'll get to do a little bit of that myself. So that's the big stuff that's coming up. We'll want to, excuse me. We're going to get into taking a look at the markets themselves. We'll start with the major indices. We'll look at some sectors and important commodities, and we may look at some breadth measures as well. Oops, we'll get to that one in just a sec. Let's start by looking at a chart of the SPY, S&P 500 ETF, and you can see that we had the big uptrend, the pullback, of course. A couple of weeks ago, we broke through this downtrend, after making this double or even, possibly triple bottom here. And in the last, week and a half, we kind of started to roll over a bit, but not too bad, really. Although, this week was, wasn't ideal. Tuesday we dropped a fair bit, and then Wednesday, and remember Wednesday was the Fed minutes came out on Wednesday. So that was very important, and that gave us a bunch of new information. The market was actually a pretty neutral response. It developed this range during the day, and if you remember the next couple of days, I was saying we need to keep an eye on this range. If we can break out and hold above the range, that's very bullish. If we break and hold below that range, that's very bearish. Well, we're still right inside that range. We've pretty much traded inside. The couple of times it did try to break out above it, it came right back in. But it hasn't failed completely yet either, at least in the S&P 500. So that's somewhat bullish. It's certainly no worse than neutral here. If we can get a push up on Monday and get above this range, and close, we'll certainly close above Wednesday's high, and even better would be closed above this resistance here in the 450 to 451 area. That would be really nice. But for now, very indecisive in here. Of course, we're not that far off the all-time highs in this, and if we look at a weekly chart, it's really hard to be bearish when you look at this chart. This doesn't look bad at all. But this is not what the market feels like. The S&P 500 is really not a good measure of what our holdings have been doing and what our portfolios have been doing, I'm sure. So as we look at some of the other indices like the Nasdaq, for instance, things aren't quite as pretty, right? We're back to a daily chart now. And you can see we had that big move down on Tuesday, and then followed by a big gap down on Wednesday, and then it too developed a bit of a range. Couldn't get back up into that gap, so that gap is still open, but it was holding the support, which also happens to be the 382 retracement of this move down off the highs. So that was an important level to hold, and also the 350 level has been an important level in the past, and even the recent past. Now on Friday we closed just below that 350 level. That's not bullish at all. This is a little scary here, because if this breaks down, if this continues to break down, we're easily coming down to the 0.236 retracement of this pullback. And this 337 level, which has been important in the past as well. So let's hope we can make a turn on Monday and actually start moving up here, because we don't want to be coming down and testing these levels, because if we start testing these levels, then there's a chance we go down to test this low here. And really ugly things could start happening if we break down below that low. Okay, and IWM's kind of a mess. If you were at the last Ticker Talk or watched the recording, I was talking about this bull flag that is set up here. I talked about this in the morning briefing as well. It did break out of that bull flag, but that certainly didn't last long. It broke out. It got above this 208 level, which has been an important level forever. If we look back at the chart, this 208 level that we had actually broken out of, goes way back to January of last year. And it, contained that range that the IWM, the Russell 2000, had been in, for the entire year, had acted as resistance. So this breakout and then failure is not good. And we've really kind of confirmed the failure. You can see here that it broke out, it failed, it came right back in, tried to break out again, and then failed. So that would have been Tuesday of last week, and then we get the gap down, and this just continued to kind of bleed away. And this one does really look like it's coming in to test at best 192, at worst this double bottom down here. Maybe it would be good if we came down and maybe it would be good if we came down and tested that double bottom and bounced right off it and then put in a nice V and started heading back up. Maybe that would give people confidence to come in and start buying these, but I don't know. It's really looking to me like this is just going to continue to consolidate or trade in this range probably through the summer, and until later in the summer, maybe even until the midterm elections. I'm not holding out much hope for the Russell 2000 or small caps anymore. I'm getting fairly bearish there. The VIX, the volatility index, this is interesting. There's interesting stuff going on here. You can see we pulled back from those highs. We had, a triple top, even maybe a quadruple top up here. Pulled back really nicely off of those. It tried to bounce up. And strangely, over the last couple of days, it did bounce up, with the Fed meeting and everything. But then it's been pulling back the last couple of days. But it's sort of put in this doji here, this indecisive candle. Seems like it can't decide which way to go. It's being supported by the 200-day moving average, but then we've got the 21-day moving average, the 100-day moving average, and the 50-day moving average overhead. So, maybe volatility is going to stay lower. Maybe it's going to consolidate in this 20 to 24 area for a little bit. And bonds. So this is the 10-year yield. You've heard me talk about before how markets generally don't like it when the yield is shooting up steeply like this. And considering how steep this has been moving up, I think that markets have held up very well. When it's steep like this, when yields are going up this fast, it is going to hit the tech sector. Most of the Nasdaq stocks and the Russell 2000 stocks, small caps, is going to hit them hardest because they're the ones that tend to burn through cash, right? So money is getting more expensive for them. We talked about the yield curve inversion and everything in the last ticker talk. So if you want to know more about that, you can go back and watch the recording on that. I don't want to get into that anymore. I think that one's been beat to death. But when we see yields going up like this, what it means is that bonds are getting sold off and sold off very hard. So the bond market right now is really kind of getting slaughtered. And people are starting to ask the question is like, does the equity market not realize that the bond market's getting slaughtered? Because usually when the bond market's getting slaughtered, the equity market is coming down quite hard as well. And like I said, it's not really doing that. The equity market is weak, but certainly not getting slaughtered at the moment. So hopefully the bond market is wrong, and equities can hold up. I certainly hope that the equity market doesn't, catch wind of what's going on in the bond market and then start selling off too. Let's look at at some commodities. So gold came up a bunch. Now normally when we're talking about inflation a lot, when you see yields going up like this, gold is usually somewhere that they run to for safety. And you can see there was a little bit of that a while ago, but now we've been consolidating in here. So I'm really not sure what's going on with gold. It is a consolidation. It could break out. It probably breaks out to the upside here. probably draw that in there, something like that. It should break out to the upside, but who knows? Gold has not really been doing what everybody expects it to do. Copper is an interesting metal again. It's really starting to tighten up in here. We've got this strong resistance here. You can see the last time we went above it, we pulled right back in, and it's been trying to sort of reach up above there and hasn't been able to do it, but they're bidding this up. We're making higher lows here, right? And it is in this longer term uptrend. So I wouldn't be at all surprised to see a breakout in copper fairly soon. So I'll be watching that one closely. And if this breaks down, it may break down fairly quickly, but there are, a number of levels of support below this. So my bias on copper is definitely to the upside. If you want to play copper, there's an ETF that is, ETN on copper that plays the physical commodity, and that is JJC. Another good way to play copper is Freeport-McMoRan. I have an options position in this, and they're a really big copper miner. So this is my favorite way to play copper. Another metal that has been doing really well and in play a fair bit is uranium. Supplies of uranium are dwindling. The producers really aren't producing very much uranium because the cost of production apparently is around around $60 a ton or something, and uranium itself is actually trading for less than that. So there's no real return in them producing a whole bunch now because they're losing money when they sell it, when they produce it. So supplies are tightening up. And you can see Cameco here has broken out to new all-time highs just on Thursday. It pulled back a little bit on Friday. But Cameco is the big player in the space. So that's one way to play it. This Sprott, now this is a Canadian equity or ETF. This is the Sprott Physical Uranium Trust. This is a really good way to play it. These guys are buying up tons of uranium and just storing it. So they're one of the reasons that uranium prices are going up right now. But as you can see, this is doing quite well. It just broke out this week from its all-time high and is making new all-time highs. There is a Pink Sheets over-the-counter version of this. I don't know the ticker on that. It's something you could look up if you're interested. What else? This one, UEC, Uranium Energy Corp. You can see it tried to break out to all-time high. This looks pretty interesting as well, very similar to CCJ, Cameco. And finally, there's an ETF for uranium. This one hasn't done as well. You can see it's good. It's quite a ways off of all-time highs. I guess because this has a lot of smaller players in it as well. But maybe this starts playing catch up. So there might be something in this. But I'd probably prefer, if I was going to play it, I'd probably prefer one of the companies. Either the Sprott Physical Uranium, although that's run a little far now. Cameco maybe, or UEC. There are some other uranium companies too that if you're interested in the space that you should look into. The DBC is a general commodities tracking ETF, and they track the physical commodities, and you can see that this is tightening up nicely into this triangle here. I expect this to break out to the upside, so this is definitely worth watching over the next few days. DBA is the agricultural commodities. This is your wheat and corn and that sort of cattle even, that sort of stuff in here. And you can see that, this had quite a nice run up and it's been consolidating in this area, but this consolidation is starting to tighten up, against resistance here. So this could be very interesting. We may see this break out as early as Monday. And I think this has got another leg up in it. So if this does break out, you can either play with this ETF directly, or look at some of the other commodity ETFs. MOO is an ETF that plays the agriculture companies. So they're not actually in the commodities like DBA is. They're in the agriculture companies. I have a position in this one. I'm pretty happy with that position at the moment, and I see that it's starting to break out above its all-time high, and out of a nice consolidation here too. That you could call it a bit of a bull flag there. So this looks like it's going to run higher. If you're looking at any of the commodities themselves and you don't want to play in the futures market, and I recommend you don't play in the futures market, there are some ETNs that invest in the commodities futures markets. But this is a safer way for the retail trader to play these. And you can see this one is corn, and this is moving up nicely. Keeps breaking out to new highs. Soybeans, quite similar here. This sort of broke out of this consolidation and looks like it's about to break out to new highs. We'll have to see. I think it will. I think with all these commodities, they are going to break out to new highs rather than roll over. And even if they do roll over, they'll probably get caught by this and supported by either this trend line or the bottom of the range here. Wheat is one that had done really well. The wheat just went crazy, pulled back, and is now consolidating in a range. It's underperforming the other commodities, but it may start playing catch up too. So this one is WEAT. So that's interesting as well. Oops. Okay, let's look at some of the equity sectors. Oh, I wanted to show you a performance chart. Where did that go? Yeah, there we go. So this is the relative performance of all these sectors within the S&P 500, and you can see on a 1 week basis, healthcare right at the top. So we got healthcare, consumer defensive. That's your consumer staples, energy, utilities, real estate. So real estate was down a little bit on the week, but real estate is fairly strong still. We'll take a look at some charts of these later. But notice all of these sectors that are at the top of the performance list for the week are all defensive sectors. Every one of these is a defensive sector. And then as we get into the more offensive or risk-on sectors, as we get down in communication services, consumer cyclicals, which is your consumer discretionary, and technology, all down at the bottom of this, all severely underperforming over the last week. And if we look at the 1 month relative performance, healthcare had such a great week that it's moved up to the top of the 1 month relative performance as well. Consumer defensive, your staples, that's right up there as well. Utilities, again, everything here it's pretty defensive. And as we go farther out in time, we can see that energy right at the top of the list. But utilities right there, in second place. So the market has definitely taken a defensive turn. There's no doubt about that. And generally, we don't want to see that. We want to see the market on offense. We want to see risk appetite in the market. That's when our growth stocks are going to do well. But this defensive turn looks like it's going to last a while. And you'll see that as we look at, get into some of the charts of these sectors. But let's start with looking at a chart of healthcare, and you can see that this is just broken out to new all-time highs. Had a little consolidation here. Maybe some people might call that a flag. Two really good up days after the FOMC minutes, and Friday was another pretty decent day. This is starting to feel a little stretched to me. Could go a little bit farther, but I think this is going to run out of gas, probably consolidate some more soon, which might be an opportunity for you to get into this space. So that's XLV, the healthcare sector. So fairly broad set of holdings there. I prefer to look a little deeper into that sector and see where the action is in there. Pharmaceuticals are a big chunk of that. You can see the pharmaceuticals have outperformed some of the other sectors, but not doing great. I mean, this isn't looking outstanding to me. But maybe there's something inside the pharmaceuticals that's doing well. And when we look, sure enough, there is. Astrazeneca. I have a position in Astrazeneca. I've got an options position on this one. Obviously, I'm very happy with it. This has just gone nuts. In the last week, really nice move in the last week, but it had a really good move before that. Again, I feel this is starting to get a little stretched. I would like to see a consolidation, maybe like we had here, because I think that would set up another leg up. So if this is something you're thinking about getting into, you're too late now, but after a consolidation, maybe there's something there. Another one that's similar to that, of course, is Pfizer, PFE. It had a good week, not as good as AstraZeneca. Maybe if AstraZeneca takes a break, maybe they rotate into Pfizer. So I would keep an eye on the two of these, because this could be breaking out here. This could be a nice move after a breakout. It may move all the way up to all-time highs. So you can definitely make money swing trading that one if it breaks out and continues to move up. So I think a pause in AstraZeneca could see money move here. Now, if we look at the biotechs, not a lot going on. They've kind of been consolidating, sort of sloping upwards here, and maybe supported by the 50-day moving average, or maybe ready to roll over and fail out of this consolidation. Tough call on this one. Biotechs is not really a space I'm ready to get into yet. I don't feel very confident about that one. However, this one, IHF, the healthcare providers, this and some of those pharma names like AstraZeneca are probably what have been pushing healthcare itself, that sector ETF up so much. And this looks good. I really like this price action in this one. I entered this on Thursday. I picked up some of this IHF, the ETF, on Thursday morning when it broke out of this base. And you can see here we have a base on a base. And I've talked about this before. I really like this setup. We've had kind of this long base. We put a double bottom in down here, consolidated some more after putting in the double bottom, broke out, put in another base, and now we're breaking out again. And we broke out to and closed at all-time highs on this ETF on Friday. Like what I'm seeing. Think there's more in it. Maybe there's a consolidation coming first. Not too sure. But I'm in from down here when I broke out of this space. So I'm quite happy with the way things are going right now. As far as getting in, tough call. But I do think there's more in this. Okay, that's about it for healthcare. XLP is the consumer staples, and you can see that has broken out to new all-time highs. Not really what we want to see, right? It's bullish if you're in ETF, but it's not really bullish for the markets, because it is, it's staples, it's defensive. It means people are running scared. They're looking to somewhere safe to put their money. What do we got? And there's a couple of retail stocks actually that are in this in staples that are doing fairly well that I'll show you in a couple of minutes. Utilities, another sector that's doing really well. I did get into this on the breakout of this pennant. I think we talked about this pennant in the last ticker talk, or possibly the one before, but we put a target up here at $80. When we were talking about, is this going to break out? Targeted $80 on this. We're getting close. We're at 77 now from a breakout just under around 72. So, doing well. Looks like it might be trying to consolidate here. Maybe there's another day or two of consolidation before this takes another leg up. But if you got in that trade, that I'd pointed out in the ticker talk, let me know. And if not, why not? Because this was an easy one. This breakout here, that was an easy trade and an easy trade to stay in. It's just moved up and up and up and up. What else we got? Real estate. This is, this is a tough one. A lot of this is commercial real estate, which is good. A lot of this is rental properties in residential. But the housing market itself, I think, is going to start running into problems really soon. We can see that in XHB. These are the home builders, and you can see they've been on their way down for a while. This is telling us that we should expect to see home prices start to roll over soon. They're just going up too much. They're at all-time highs. They've been moving up too steeply. I don't want to call it a bubble, but I think that it needs to chill out. New home prices need to chill out. And you can see that XHB, the home builders, have been telling us that for a little while. Back to REITs. You can see these are moving up. Now, if this is a bull flag, we do not like upward sloping bull flags because those usually fail. And so, I think the best thing for this would be to consolidate sideways for a little bit. Clear this out a little bit, and then it'd probably be ready for another leg up. But I don't expect this to keep going up sort of in this direction like it has been, staying in this channel for much longer. I think it needs to pause, or if it, it could very well roll over. And there's a gap down here to fill as well if it does roll over. Energy. So a lot going on in energy. So this is XLE, the energy ETF. This is not oil. These are the oil companies. Any companies involved in the energy sector, and you can see that this is trying to break out to new highs. Nice uptrend. Sort of made, right angle triangle here, or not a right angle, but it made a triangle in here in this consolidation. Tightened up nicely, and then on Friday broke out almost at new all-time high. Probably will be at an all-time high on Monday, unless oil comes down a lot over the weekend. I'm sorry, not over the weekend, overnight. Oil markets haven't opened yet as I'm recording this, so don't know what's going on with oil yet. But definitely worth something keeping an eye on here. So remember, though, this is the oil companies. What's really interesting, when we look at crude oil itself, it's not showing the same sort of behavior at all. It has been now in a short-term downtrend and trending down, but it seems to have found some support here. We had a little bit of indecision here. We had a half-decent candle on Friday. Is this ready to move back up? Well, the oil companies are telling us this is going to move back up. Oil companies are very bullish on oil right now. You'll see that in a sec. I've queued some up for us to look at. So I would expect to see oil start moving back up, because when we look at these oil companies some of the industry groups within the energy sector, we'll see that those are all looking very bullish. So this is XOP. This is an ETF that tracks the oil and gas producers, and you can see that uptrend here, very similar to XLE. We have a nice little base here, and we look ready to break out of that base. We've got OIH, which is the Oil Services ETF. So these are your pipelines and oil drillers and suppliers to the oil industry. And you can see that this is, nice uptrend, has built a nice base here, and looks ready to break out of this base. When we look at some of the individual companies, we'll look at Exxon Mobil. That one broke out of its base on Friday and looks ready to go attack these. I think that's all-time high. If not all-time high, that's definitely a one-year high right there. This looks ready to go. This is not saying that oil is going to roll over and die. This is saying that oil continues on its way up. Occidental Petroleum, this is the one that Buffett bought. This is, breaking out, tried to break out of that little triangle there, came back in, found support at the 21-day moving average and looks, had a really good day on Friday and looks ready to go and break out to new highs. Devon Energy, a smaller one. It looks ready to go break out of this resistance here, like some of its peers already have. So this might be a good one if you want to play in that space. Marathon Oil, another one that's made a nice little base here and looks ready to break out of it. Really nice, well-behaved channel on that one. Schlumberger, this is one of the oil and gas equipment and services companies. Drawing a nice pennant in here. Looks ready to break out. You could play that, nice little swing trade here. If it breaks out basically above yesterday or Friday's high, or above, say, a little bit above 43, say, that could be a good entry. And remember, this is not investment advice. I'm just sort of, demonstrating one way that to play this and a way I might play this. Play a breakout above 43 with a stop just below Friday's candle. Size your position accordingly for your stop in there. That's looks like a nice easy play right there setting up. So there's a lot going on in that energy sector, at least the oil sector. I think there's still some money to be made in that. Where are we going to move on to? Oh yeah, we want to look at financials. Financials are, I don't know, I just have a gut feeling about financials for some reason. And I don't usually play my gut, but maybe my subconscious is telling me something here. So this is financials, this is XLF, the financial sector ETF. Okay, so I put some Fibonacci's on this from this high down to this low, and you can see that really we're in a downtrend. It had been making kept making lower lows. Looked like maybe we'd had a double bottom in here, but it broke down through that. It came up and it had a strong rebound. And that looked really good. And then it fell apart here and came down really weak in here. Looked like it was going to support at that 382 retracement. It came all the way down to the 236 retracement and bounced nicely there. Put in this what do you call this? Dragonfly, either a long-legged doji or a dragonfly doji. I can't remember which one it is, but this is a very bullish candle here. These three candles really, you've got a little bit of a gap down. You've got this gap down here, and it held. Then you've got this big sell-off day, kind of capitulation, right, and goes right back up again, and then you've got a nice bullish day following that. I really like that sort of three-candle setup. I really think financials are moving higher. Now, that being said, there is a lot of resistance overhead. Look at all these moving averages bunched up there, and that 0.5 retracement. So if financials are going to do it, they've got to have another good day on Monday. And we'll look at some of the stock, a couple of stocks that I like in that space in a sec. But I also wanted to show you. So this is bullish. This is a bullish pattern here, but when we look at the banks ETF, KBE, doesn't look bullish at all. This is not showing the same sort of behavior. We did have an inside day on Friday. That's about the only bullish thing I can say about this chart. And when we look at KRE, which is the regional banks, so these tend to be smaller, and these are the ones that are in a lot of these are in the Russell 2000, the small caps ETF, or IWM, the small caps ETF. You'll find a lot of these small regional banks in there. This doesn't look terribly healthy either, right? So why are financials going up? Insurance isn't looking all that great either. And I think it might be some of these big banks that are reporting earnings this week. So if we look at JP Morgan, this looks good. And I took a position in JP Morgan via an options play on, it was either late on Thursday or early Friday. I can't remember when I did that. I think it was late Thursday that I went in there. When I saw this reversal, I thought, you know what, I really like this. And then was rewarded yesterday on that. So that looks, very, very similar to what we saw in the XLF there. And again, I think this continues to move higher. Warning, earnings are Wednesday morning in this. Oh, and by the way, I did post the options play that I took on this. I did post that in the options channel if you want to go take a look at that. Goldman Sachs also has a similar look. Nice looking hammer there, and followed through with a nice big green candle the next day. Closed that gap, but did pull back and closed, inside of that gap. So this still has work to do as well. And Morgan Stanley. Now all these guys are reporting this week, so you want to be careful if you're going to play these. But they do look interesting. I think that the expectation for earnings on these guys is bad. But I think that expectations are so low. The bar has been set so low for these. I think they can. I think they can surprise. And if they surprise, I think that maybe the bottom might be in on these. So that'll be interesting to watch this week. Technology, this sector is just nothing going on here. Really, don't really see anything good. I think we're consolidating. I think we're going to be in a range for a while yet. Probably if a couple few more months in a range on these. I don't think we break these lows down here though. We may come down close to them, but I don't think they break. I think they hold. Communication sector, really the same thing. I don't think we break. I don't think we go to new lows, but I wouldn't be surprised if we come down and test them. I'm expecting a range on these. And then we look at some of the names in there, especially, we look at the FANGs. They're not doing anything exciting. Maybe Facebook is ready to turn up here. That would be good, for tech stocks, especially the bigger, larger cap tech stocks, because it's put in this low. If it can put in a higher low here, that'd be great. Looks like there's a chance that turns up. Apple's the star in this space. But it really needs to turn up here, and there should be a fair bit of support here. We've got the 100-day moving average, the 50-day moving average just below. It did lose the 21-day moving average on Friday, though. So hard to say. If it does come down, probably comes down to this trend line, which is right near the 200-day moving average. I'd be surprised if it spent any time below that. Could do something like we saw here, where it comes down, it breaks below that trend line and 200-day moving average, then it shoots right back up again. People will buy Apple when it starts looking cheap. Amazon, not very exciting, not looking very healthy at all over the last week. Maybe it's finding support of that 50-day moving average. Hard to say. If it doesn't support, there's definitely, it could continue to move down fairly quickly here, I think. But again, I don't think it's breaking this double bottom if it comes down this far. Netflix not looking good at all. Just can't seem to, get up and move away from this. So we would probably want to be looking at this level here to the upside. So that's about 400. On the downside, maybe 350 or this low here. You don't want to see that one break that low. And Google. Google's looking okay, but not great. It needs to reverse this move down from the following week, but it should be coming into some support in this area, especially in around the 2600 level. And then worst case scenario down to 2500. It's a no-brainer that it supports 2500 if it comes down that far. Should actually draw that line in there, shouldn't I? I think that's right about there. Yeah. Okay. There you go. This 2500 level's got a support on that. Just a couple more now. Semiconductors not looking great. If tech's not looking good, then semiconductors aren't looking very good. And cloud stocks aren't doing well. Software's not doing well. They all kind of look like this, so I won't bother showing you those. There's nothing to do in this space for now except wait. Retail it's funny that the retail ETF doesn't look all that good, except does look like it's putting in a bottoming process. Looks like it needs to consolidate a while longer. Maybe we see a consolidation in this area go on for a couple of months or more. But there are some really interesting stocks within retail. Dollar Tree is one. Now, Dollar Tree is a stock that should do well in a recession, right? Everybody's been talking about recession. This should do well if there's a recession. It's got a bunch of cheap stuff. People love cheap stuff. People want to save money. They're going to be going to a store like Dollar Tree. And it's doing really well right now, and it's broken out to I think that's a new all-time high. Definitely all-time high on that one. So that could be interesting. Bounced really nicely off the 21-day moving average. Breaking out. If this continues tomorrow, there could be a play there. I like buying strength. I like momentum plays. This definitely has momentum. Costco, another stock that has momentum. Another company that should do fairly well in a recession. People can go there to save money by buying in bulk, right? This has been doing well. Took a little bit of a break on Friday, but look at that move on Thursday. Wow. Really strong. See no reason why this wouldn't continue to be strong. Target. Not as good as some of the others we've just looked at, but definitely breaking this downtrend and trying to make the move. I mean, it's had a good move this week. Did get stalled on the 200-day moving average, though. Maybe it sets up a nice little bull flag here. That would actually be pretty cool. If we set up a bull flag, something that looks like this, and then break out of it, and we did that right under the 200-day moving average, this would make for a really nice breakout. This would be a really nice play if something like that happened. So I'll just leave that on there. And we'll see next time what happened with that. But worth keeping an eye on to see what happens. Walmart. This has just been a monster too, over the last month and a half. Just a freight train on the way up. There was a bit of a consolidation. Bull flag here. Could have got you in. This probably needs to consolidate before this makes another leg up. Consolidation right in here right now would be good spot. Watch for a bull flag, break out of there. Maybe that's playable. And finally, the last one, this sector that I noticed today, and I haven't had a lot of time to really dig into this, but this is PBJ. This is the Food and Beverage ETF. And I'm not sure why this is doing so well. I can't recall any the restaurant companies or anything that are doing really well. This could be there will be a lot of staples type companies in this, and maybe this is sort of getting a lift from the staples. Maybe this is a bit of a staples play. I want to look a little deeper into this because this is a nice move, and this is another one that could maybe after a consolidation it could set up a nice little entry. But I think that's all I've got for today. I hope everybody enjoyed that. If anybody, like I said before, if anybody has any questions, shoot me a message in one of the channels, the stock market chat or the Ask a Mentor channel, or you can DM me if you want. So hope everybody enjoys the rest of their Sunday, and we will see you all next week. Thanks.